Welcome to the fascinating world of Bitcoin. Did you know that nearly 19 million of the 21 million Bitcoin have already been mined? That means only about 2 million Bitcoin are left to discover, making this digital currency scarcer than gold. In fact, as of 2023, Bitcoin is becoming increasingly popular, with over 300 million users worldwide. But here's a shocking fact: 70% of people still have no idea how Bitcoin really works. Many see it as just a risky gamble, but there's so much more beneath the surface. Bitcoin operates on a technology called blockchain, which allows for secure transactions without banks or middlemen. This could change the way we think about money forever. In this video, we'll uncover the hidden gems of Bitcoin that value investors can't ignore. We'll explore why Bitcoin is more than just digital money and how its unique features align with timeless investing strategies. You'll discover how its scarcity, network effect, and potential for future growth make it an exciting investment opportunity. So, whether you're a seasoned investor or just curious about Bitcoin, stay tuned. You're about to dive into a world that could change your perspective on wealth and investing forever. Chapter 1. Bitcoin's core. A value investor's hidden gem. Most people think of Bitcoin as a risky, speculative bet, but what if we looked at it differently? For value investors, it's easy to dismiss something as new and volatile as Bitcoin. But if we dig into its core principles, we find traits that would make any value investor curious. At its heart, Bitcoin operates on a fixed supply. There will only ever be 21 million Bitcoin in circulation, unlike fiat currencies that can be printed indefinitely. Scarcity like this drives value, a principle any value investor would recognize. In fact, this characteristic makes Bitcoin comparable to commodities like gold. Think about Warren Buffett's approach to finding undervalued stocks. He's famous for looking for assets trading below their intrinsic value. Bitcoin has no traditional, intrinsic value, in terms of revenue or earnings, but its scarcity and utility could be seen as a new form of intrinsic worth. A study by Glassnode showed that over 65% of Bitcoin's supply hasn't moved in over a year. This points to investors treating Bitcoin as a store of value, not just a quick trade. Long-term holders, often called HODLers, believe in its future value growth, just like a value investor believes in a solid stock. Additionally, Bitcoin's decentralized nature and censorship resistance give it unique value that traditional financial assets lack. Imagine a stock or fiat currency that couldn't be manipulated by governments or institutions. For investors who value independence and long-term stability, this alone makes Bitcoin worth a second look. Chapter 2. The Digital Gold Mine. Uncovering Bitcoin's true potential. Many still argue that Bitcoin is just internet money. But if you think of it as a digital version of gold, it suddenly looks like an asset with huge value investing potential. Gold has been a trusted store of value for thousands of years. Why? Because of its scarcity and resistance to inflation. Bitcoin holds the same appeal. The difference? It's more portable, divisible, and liquid than gold. In 2020, Paul Tudor Jones, a well-known value investor, called Bitcoin the fastest horse in the race against inflation. Consider this: the global market for gold is worth around $12 trillion. Bitcoin's market cap is only about $500 billion as of 2024. If Bitcoin captures even a fraction of gold's market share, its value could rise significantly. Historically, Bitcoin's price has grown over time, especially during periods of economic uncertainty when investors seek alternatives to fiat currency. Bitcoin also offers something gold cannot: utility in a digital economy. As the world moves toward decentralized finance, DeFi, and blockchain-based systems, Bitcoin's role could expand further. Value investors often focus on assets that can generate future cash flow or provide utility. While Bitcoin doesn't generate dividends or cash flow, its use case in the digital economy could be the utility component that value investors often overlook. If you can hold something as useful as cash but immune to inflation, isn't that a long-term win? Chapter 3. Debunking Bitcoin myths. Why it's not just a speculation play. A lot of value investors shy away from Bitcoin because they think it's just a speculation bubble. They see its volatile price swings and think, this isn't for me. But volatility alone doesn't define an asset's worth. Stocks can be volatile, too, yet people still invest in them based on their fundamentals. Bitcoin deserves the same consideration. The volatility argument falls apart when you look at the data. Despite its price fluctuations, Bitcoin has averaged an annual return of 230% over the past decade, according to Masari. Additionally, the idea that Bitcoin is purely speculative ignores the fact that it's becoming more widely adopted. Big institutions like Tesla, MicroStrategy, and even some governments have started holding Bitcoin on their balance sheets. This level of institutional adoption is a sign that Bitcoin's value is being recognized beyond retail speculation. And it's not just big corporations. In countries with unstable economies, like Venezuela, Bitcoin is used as a reliable form of currency because it holds value better than local currencies. For value investors, the key is understanding that Bitcoin's volatility is a byproduct of its growing adoption and evolving market. It's not that Bitcoin is a speculative asset, it's that the world is still adjusting to it. Think of how the early internet or tech stocks were perceived. In the 1990s, Amazon was seen as highly speculative. Yet, value investors who understood its long-term potential were rewarded. So, if you find this content valuable, consider subscribing for more insights on Bitcoin and value investing. Chapter 4. Bitcoin's Network Effect. The compounding value. You're missing one of the most overlooked aspects of Bitcoin is its network effect. In simple terms, as more people adopt Bitcoin, its value grows exponentially. This is not a new idea. In fact, it's a principle that has been applied to successful businesses for years. Think about Facebook or even Amazon. As more users join their platforms, the overall value of these companies skyrockets because the network itself becomes more valuable. Bitcoin works in a similar way. The more people use it, invest in it, and build around it, the more valuable the entire ecosystem becomes. Metcalfe's law, which states that the value of a network is proportional to the square of its users, applies perfectly here. In Bitcoin's case, as millions of users, institutions, and even governments adopt it, its value compounds in ways that are hard to predict but easy to benefit from if you're an early investor. What's unique about Bitcoin is that it's not just a financial asset, it's a growing technology. According to Chainalysis, Bitcoin adoption grew over 880% in 2021 alone. As more people adopt and use Bitcoin, whether for payments, investment, or as a store of value, the network strengthens. It's like investing in the internet in the early 1990s. The world didn't fully understand its potential yet, but those who saw the vision gained incredible value. For value investors, understanding the compounding network effect could mean realizing that Bitcoin's value is not just in its price today but in its growing global adoption. With each new user, the network becomes stronger, the security grows, and the value follows. Chapter 5. Warren Buffett's Blind Spot. Bitcoin's value proposition explained. Warren Buffett is one of the most respected investors in the world, but even legends can miss the mark sometimes. Buffett has famously called Bitcoin, rat poison squared. For many value investors, that statement alone was enough to dismiss Bitcoin. But what if Buffett's aversion to Bitcoin is less about its lack of value and more about his own blind spot when it comes to new technologies? Buffett is a master of identifying value in traditional businesses, but he's never been a fan of tech. He also passed on early investments in companies like Amazon and Google. Why? Because they didn't fit his traditional mold of cash flow-based value. The same could be said for Bitcoin. It doesn't generate revenue or dividends, but that doesn't mean it lacks value. In fact, Bitcoin's value lies in its potential as a digital store of wealth, which doesn't neatly fit into traditional financial models. While Buffett values companies that can generate predictable profits, Bitcoin represents a different kind of value, one built on scarcity, decentralization, and the potential for global adoption. Peter Thiel, a co-founder of PayPal, has even described Bitcoin as a bet on the collapse of the current financial system. From this perspective, it's not about comparing Bitcoin to a business, it's about seeing it as a hedge against the fiat-based financial system, much like Buffett's love for gold in unstable markets. So, is it possible that Buffett's bias toward traditional investments blinds him to Bitcoin's future value? Value investors who can think outside the box and embrace innovation may find that Bitcoin has more in common with traditional investments than it seems on the surface. After all, there was a time when tech companies like Amazon were considered speculative too. If you found this content helpful and insightful, Don't forget to subscribe for more updates on Bitcoin and value investing. Join us as we explore the future of finance together.